Hello, everyone, and welcome. Thank you so much for joining today's webinar. Our topic is improving enterprise efficiency, streamlining financial planning for long-term profitability. My name is Kelly Brennan. I'm an enterprise sales representative at eMoney Advisor, and I will be your host for today's session. I'm also joined by Connor Sung, Manager of Practice Management Consulting at eMoney Advisor.
Hello, everyone. Thanks for joining us.
So today we'll be talking about inefficiencies at the enterprise level. We'll examine closely how advisors are spending their limited time and where the major sources of inefficiencies are. From there, we'll discuss action items and tech-driven solutions that can help firms increase efficiency, improve their client experiences, and even realize higher profit margins. So before we jump in here, everyone, just some quick housekeeping items. You can ask questions at any time during this session by typing them at the bottom of the screen. And what Connor and I will do is at the very end of this session and webinar, we will leave some time to answer those questions and make sure that we get each and every one addressed. We'll also send everyone who joined the session today a copy of the slide deck that we are walking through after this webinar. So with that, let's jump right in here and take a closer look at how financial advisors are spending their time. So I think it's safe to say that you all have a great understanding of your advisors and how they spend their day every single day. And at eMoney Advisor, we're really at the front lines because we work so closely with firms on a daily basis to help them integrate eMoney into their business model. Because of this, we have been able to learn so much about how advisors can improve efficiency. And, both of us are really excited to bring this knowledge to you today so that ultimately you can impact your advisors and really deliver value. So let's focus on the key metrics here. So the average advisor is spending approximately 27 hours per week on activities directly related to clients. This includes things such as meeting with clients, preparing for client meetings, analyzing plans, and other client servicing tasks. So direct client activity accounts for the majority of their time. Outside of these responsibilities, advisors are spending the most time on business development, including meeting with prospects and other marketing-related activities, followed by investment management and admin work. Professional development and other management activities make up a small but not insignificant portion of an advisor's week. So all in all, when we look at this as a whole, this adds up to about 53 hours of work every single week. At first glance, it's easy to see that advisors have a wide range of responsibilities and that they're pulled in many different directions. But when we dig deeper here into this breakdown, it really reveals that advisors aren't as productive as they could be. So if we drill down into, some of these key details, with 27 hours of an advisor's week being spent on activities directly related to clients, that's only about 50% of their time that they're actively working for their clients. Less than 20% of an advisor's time is spent meeting with their clients. So they're actually spending just as much time meeting with prospects and trying to acquire new business as they are meeting with their current clients. And in terms of financial planning, advisors spend less than 10% of their time managing investments. So if the average advisor has 96 clients, this works out to only about 2.9 hours of investment management per client per year. It's safe to say that enterprise firms really want their advisors to spend time on revenue-generating activities. So things like engaging existing customers to cultivate long-term relationships, diving deep into financial goals to improve the client experience, as well as finding ways to deliver a higher number of quality plans. We know that's a huge topic across the industry right now. This breakdown of how advisors are spending their time really just shows how much advisors are being pulled away from activities that generate revenue. The question that firms need to ask themselves, especially now more than ever, is what exactly is pulling advisors away from their core responsibilities? And what kinds of inefficiencies can be phased out of the planning process? For that, I'll turn things over to Connor, who has some really great insight on this topic.
Thanks, Kelly. These are all really great questions that pretty much every firm should be asking themselves. Working as part of the practice management consultant team at eMoney, I speak with a lot of different types of firms, and really a lot of what comes out is what's holding their advisors back. Me and the rest of the team help identify those firm-wide issues and inefficiencies and try and help find solutions to fix them. In conversations with these firms, there's really three major or key inefficiencies that pop up time and time again. First, the lack of tech integration between different technology solutions really disrupts the flow of data between systems, obviously creating direct inefficiencies, forcing advisors and advisor teams to find workarounds for using their data from multiple different sources and different tools. Poor data flow bogs down the entire planning process because advisors are spending time managing their data as well as actually just entering it instead of doing things that are revenue generating or analyzing that data. Then probably secondary, we have some level of administrative work, or what we like to call administrivia. Every advisor is familiar with how distracting these things can be, whether it's helping clients transfer money, resetting passwords, sending easy statements. There's no shortage of tasks to pull advisors away from essentially their core responsibilities. And lastly, there's client onboarding and data gathering. A powerful aggregation engine, this process is really manual without that aggregation. And because you're having to enter all of those things and potentially in conjunction with that lack of tech integration, data gathering essentially relies on multiple meetings with clients. So not only are you having to spend the time entering that data multiple times, but you're also having to ask your clients multiple times. So both extremely time consuming for the advisors and for their clients. If we take a look at each one of these individually in depth, we'll see there's a tech-driven solution for each, as well as a way for advisors to really reinvest the time that they're saving and putting that back towards revenue-generating activities. And enterprises have a lot to gain here. Even small increases in efficiency at the advisor level, scaled across an entire firm, can yield pretty impressive gains in profitability as well as improved client experience. So first, we're going to take a look at the lack of tech integration. This is a very common problem with enterprise firms because as AUM grows, as headcount grows, as client needs change, as firm goals change, you've really been buying technology solutions to fit holes within the planning process or to fit client needs. The kind of piecemeal approach really helps put out those individual fires as they come up, but in the long term, it usually leads to a disrupted and confusing workflow between all of the different systems because the tech integration aspect was never really a top consideration or concern when the solution was originally purchased. When this is the case, advisors have to spend excessive amounts of time essentially figuring out how to connect all of the different pieces of technology they've been given, how to basically mesh all of the different aspects of their own individual tech stack that's been made available to them, and just to make sense of all of the different bits and pieces. It slows down the financial planning process significantly. Any planned updates take much longer because there's no single point of entry for everything to be pushed through. Poor integration is, number one, a bad employee experience, but it also creates a bad client experience too. They have to provide their financial information multiple times, which understandably is frustrating. You're talking about their financial lives, and it's a very personal thing, and having to ask multiple times is not a great experience. Tech integration is a common but major problem, and the biggest piece of that is that it slows down the planning process, and it creates a barrier to advisors to doing planning. And these efficiencies definitely need to be addressed if a firm is going to continue to grow.
So, you bring up such a great point, Connor, and that tech integration, that's such an important part of a firm's growth. If we look at the research behind this, 68% of enterprise ensembles and 64% of super ensemble firms say that a lack of tech integration is the biggest pain point in their technology process. And larger firms are much more likely than smaller firms to list integration as their primary technology problem. However, at the same time, advisors are keenly aware of the role technology plays in their firm's growth as well. So as we can see here, only 7% don't believe technology played a significant role in their firm's growth in 2019, which is down from 17% in 2015. And when asked about what's most critical to achieving their firm's goals for growth, 56% of advisors say fully utilizing current technology is most important, compared to 37% who say investing in new technology is most important. So once again, larger firms were much more likely to say that better using current technology is critical for growth. And this is what we're focusing on across the industry as well, and having a lot of conversations with firms about it. It's how do you take the technology that you have and better integrate it? And really, as the flow of data can be improved in existing systems, a lot of the problems that come with tech integration would be solved. It's not necessarily about me too technology buying and continuing to just pile on technology after technology. It's really creating the right core experience and integrating it all together to create the right workflow for your advisors.
That's so true. And firms that experience inefficiencies from that lack of tech integration really need to essentially reevaluate their entire tech stack. We always recommend that firms kind of take a step back and look at the whole process, not just individual pieces of that process, but the entire advisor and end client experience. It's really important to examine each piece of technology and really understand what pieces of data and what pieces of functionality and features are actually used within that system. Because with a better understanding of advisors' frustrations dealing with the multiple streams of data, firms can build and architect a data flow that make advisors' lives easier in the short term, which has a number of benefits in and of itself. And in the long term, obviously, firms that do provide this themselves, building a solid framework for their financial planning process, pushing towards all of those things around planning adoption and technology adoption. But really, the key thing being that any new technology that's added needs to be evaluated for not just its features and functionality on its own, but its fit within the total existing tech stack and experience that the advisors have. But when the time comes that advisors spend managing data is cut out of their work week, they have an abundance of time to reinvest in creating more plans and potentially even doing more prospecting. A faster, more efficient planning process gives each advisor the ability to take on more clients while improving the whole firm's ability to scale planning and technology, and hopefully increasing revenues directly from financial planning engagements. On top of this, if plans can be produced more quickly, advisors can have more engaging conversations with prospects by producing basic plans, increasing the likelihood they'll become essentially full-paying clients. When advisors can spend more time doing what they do best, clients benefit too. They have a better experience when they only have to provide their financial information once or twice, potentially once or twice a year, instead of having to update it any time that the plan needs to be updated. I actually recently worked with a firm that saw dramatic improvements in their financial planning process simply by ensuring that they had the right integrations in place. And when I first met with them, they weren't using their financial planning software essentially to its fullest potential. They were inputting data twice, once into their planning software and once into Excel to build each household's asset allocation. Essentially what they were doing was having each paraplanner go into Morningstar and actually look up individual holdings for classification purposes. So manually inputting classifications, manually inputting pages and pages of holdings, a lot of human error, but essentially through the right tech integrations and aggregation, we're able to save about 6 hours per plan update. And that's 6 hours on the initial implementation or build of the plan, and that's 6 hours annually that they don't have to go back in and spend that time redoing the classifications. And it sounds a little outlandish, but it's way more common than you would expect. And as you can imagine, just how much time advisors and those advisor teams got back to reinvest in more productive activities. Addressing inefficiencies from the lack of tech integration is, one larger way that firms have found time to give back to advisors, but there's definitely other ways that firms can address inefficiencies as well. And the next piece, or the next inefficiency we're going to touch on, is that idea of data gathering and client onboarding. And it is really focusing around that idea of manual versions of this. it's one of the most time-consuming aspects of the financial planning process. Setting up a new client, collecting all their financial information from all their institutions can be taxing, as well as taxing on the client, right? If this is their first engagement with a financial professional, they might be a little unwilling to share some of these pieces, and you're asking them for a lot of personal information about things that they're aiming towards in their life. But ensuring, when that time comes and you need to get to that level of additional data gathering and initial data gathering, we just need to make sure that that process is not completely manual and that advisors are able to get that full financial picture in order to build an effective, comprehensive financial plan, and that clients don't feel the slow, tedious nature of that. I think any advisor will tell you how labor-intensive that process is, as well as how much time they'd save if it were automated and then they didn't have to spend any time there. And the onboarding of clients isn't necessarily a revenue-generating activity on its own, but that starting of the relationship with such a monotonous task is not a great way to start a brand new long-term relationship.
Yeah, Connor, I think that's such a great point. That part of the financial planning process is extremely time-consuming. We see this time and time again and get feedback all the time about that pain point when we're first introducing an advisor to the idea of eMoney technology and a new way of approaching this. So if you break down how much time an advisor spends on each step in the financial planning process in the first 12 months of a relationship, they're spending about 5.4 hours establishing the relationship and bringing clients on board, and an additional 4.8 hours just gathering the data. This turns out to be quite a lot of time. It's about over 10 hours for every new client an advisor brings on. You can see where this would be a barrier for scalability and growth for any advisor or firm. Onboarding and data gathering works out to be just about 30% of an advisor's total time spent on financial planning, which means a third of the work of financial planning is done before a plan can even be created or analyzed. So, of course, advisors will always need to spend some time bringing on new clients and gathering their assets. We know that's an important piece of things. We also know the plan is only as good as the data that you're gathering on the client. But a question that firms really need to ask themselves is, does it really need to account for a third of the financial planning process? And how can we better streamline this?
And it really is a widespread problem for enterprise firms, definitely. And a lot of the firms I meet with tell me that, onboarding and data gathering is extremely inefficient. And that's really why we always recommend using a technology solution that has an aggregation engine built into it. That way, you're getting that level of tech integration, but you're also streamlining and making a piece of the financial planning process more efficient or more time-saving than what the advisors could have done had they done all of it manually. That you're able to connect accounts from hundreds of different institutions, both under management assets as well as those third-party or held-away accounts, and every checking, savings, mortgage, insurance policies, most of their financial life, and being able to obtain those things through direct feeds or through connections in general, meaning that the client's data is always accurate and updated on at least a daily basis. And that account aggregation technology really does slash the time it takes to onboard clients and gather and update their data. With all the time that's saved through account aggregation, advisors can reinvest that time going deeper into financial plans. Advisors that are empowered by account aggregation really get, number one, better insight to a client's entire financial picture, because you're then having them log into basically every institution where they hold accounts. So hoping that, you are getting 100% of view, at least, into all of their assets. But it allows them to have more time analyzing and developing that financial plan because you're not spending it manually entering holdings and looking up classifications. So we are really aligning more closely advisors with the client's best interest, and also improving not just the quality of advice, but the quantity as well, which definitely flows all the way through to the end client experience. And hopefully That leads to higher client satisfaction as well as higher retention and hopefully increased referrals. A client of ours that recently launched a not-for-profit initiative to offer financial planning to students is a great example of how aggregation has saved huge amounts of time. In this not-for-profit, the client connected millennial students with professors who were working in financial planning undergraduate programs. As the initiative got going, it was clear that the process just wasn't quite efficient enough for the professors to be able to deliver financial plans actually, or have financial planning discussions with the students themselves. And most of the time was spent actually gathering financial information from the students. So what we did was we worked with our clients' advisors, so the professors themselves, to use account aggregation technology for the professors. It solved most of the inefficiency around the process that they were going through and really allowed the professors to have deeper planning conversations. And at that level, obviously, we're still talking about spending, general spending and saving goals, but still being able to get to that next level and let the undergraduate financial planning students see what an actual client engagement would look like. So that gives them some idea of what to expect in their future. Powerful account aggregation drastically reduces the amount of time it takes to onboard them and gather all of their financial data. And advisors have a great opportunity to reinvest all of that time into their financial planning process, hopefully to deliver more impactful plans that really help improve the overall client experience. And as I mentioned earlier, another common area of inefficiency for enterprises is the amount of administrative work that advisors must do. And that, again, is that quote, administrivia. An advisor's work week can quickly get bogged down with menial but very time-consuming tasks. Things like sending a balance sheet, transferring money, opening new accounts, actually resetting passwords, just in general supporting their clients outside of the actual delivery or analysis of their financial plan. It takes time, and clients can create more work too when they ask basic questions about their financial plan, how it's presented, or even when they ask for access to their plan in the first place. Extra administrative work can come from a lot of different places, and it can quickly start pulling advisors away from their core responsibilities.
So that's such a true statement, Connor. If we really dig into this, excessive administrative work is definitely an industry-wide problem. While there will always be some degree of admin work that financial advisors have to do, research shows that there's an enormous opportunity to create efficiencies in this area. A recent study showed that 22% of an advisor's time, on average, is spent on administrative work. This includes day-to-day management, compliance, and other admin activities. So that's nearly a quarter of the average advisor's time that's spent on activities not related to planning or servicing clients. In some cases, advisors are spending up to 40% of their time on back office duties. Clearly, this is an area firms can focus on to get advisors spending more time on productive activities. Firms that can reduce back office duties to 10% of an advisor's time see their valuation grow from 15 to 20%, which is pretty great. So there's a lot to be gained here for enterprise firms. But it's also important to note that this admin work can come from many different areas of an advisor's practice. Connor just talked about that a few minutes ago. Where exactly is this coming from? And some of the insight into how and why this is occurring is important. The same study showed that the top 3 challenges to productivity as identified by practice management professionals are number 1, inconsistent procedures, number 2, ineffective delegation to staff, and number 3, a lack of process mapping and documentation. This would suggest that much of the admin work that's falling on advisors' shoulders can be directed out elsewhere. So they can come up with new processes. They also can focus on really delegating this work to the right member of their team.
And that's so true, Kelly, that idea and that word of delegation. I know it's hard for some people to actually give up responsibility and ownership because they're concerned about the quality, but it is one of the major things that we're telling firms when we see advisors getting bogged down by administrative work. And really that first recommendation we make is to break up the roles and responsibilities of staff in a highly visible way. This could mean hiring a junior advisor to handle less complex planning needs. It could involve hiring some other support staff to take over some of the administrative work. But either way, you're really trying to get to a place where the advisor's day-to-day and their major workload needs to be things that are core to their responsibilities, and their responsibilities meaning delivering a great client experience, getting new clients, and actually delivering financial plans. And this concept has been taken kind of even one step further by, let's talk about segmenting clients and planning service models. So for example, clients with less time-consuming plans could be charged less for a simpler plan completed by a junior advisor potentially. So not only are you delivering a financial plan to a client that may not have gotten one from you before, but you're also having a junior advisor kind of cutting their teeth at the firm value and getting used to client conversations and getting ready to be groomed essentially to get up to that, kind of that pro level of financial plan. It also allows you to essentially prioritize the advisor's time on activities that generate the most revenue, or focus on the clients that generate the most revenue and leave the less productive tasks to other employees. Another thing we recommend firms do is to create a really robust client experience online. And typically clients have a lot of questions about how their money is managed or what's happening within their financial lives. And answering all of these basic questions can become burdensome on advisors and advisor teams, really, again, taking them away from planning and prospecting activities. Building a client site that's easy to access and can let clients answer their own questions can drastically reduce the number of basic questions advisors have to answer. With the right technology in place to segment and scale planning, while giving clients greater insight into their plan's performance, advisors are really freed up to reinvest their time in developing deeper, long-term relationships with, again, their most valuable clients. Instead of answering those simple questions or helping reset passwords, the right tech solutions in the advisor's hands allow them to go much deeper into clients' financial goals and plans and have more productive and more engaging conversations. This hopefully will lead to that idea of a much more improved client experience and, again, client retention, but really, at the bottom, helping clients achieve what they truly want to get to. Being able to have that time to figure out that why at the end of the tunnel. Why am I working still? Why am I setting up all these goals? Why am I in this office with you? And getting to that place of client satisfaction and kind of past goal achievement, but life satisfaction. Not to mention that advisors who connect with their clients in this way are offering a much more valuable service, because again, we're getting past just the financial plan and trying to help clients get to that level of kind of life completion. Phil Simonet of Simonet Financial Group is a great example of an advisor that's utilizing a client experience at the forefront of his planning process. We have a case study of Simonet Financial, which is available within the eMoney site if you're interested in reading the whole thing. But to summarize, Bill began developing comprehensive financial plans based on his client's true financial and life goals. But to bridge what he saw as a communication gap that separated advisors and clients, he really started implementing a client portal to help deepen the relationship between his clients and his team and really get to that more valuable service past the financial plan. After offering this type of planning and building stronger relationships, Bill was able to more than triple what he charges for each individual plan, while better serving and retaining his clients. While not everyone will be able to triple their fees, freeing up advisors' time to spend more time developing better client relationships can help with long-term retention, increasing the value of planning services, as well as directly contributing to higher profit margins. So, to recap, the three major sources of inefficiencies in enterprise firms are, number one, the lack of tech integration. data gathering and client onboarding, as well as excessive administrative work. One thing you may have noticed as we've talked about these action items is that technology is the heart of solving all of these inefficiencies. When I talk to enterprise firms about creating efficiencies, the conversation almost always surrounds their tech stack. When it comes to integrating existing systems, financial planning software with robust integrations, connections, APIs, aggregation, it really helps to facilitate a streamed workflow between all of the different data systems. This gives advisors everything they need in one place without having to manipulate data and having to massage it through workarounds to get everything connected and get it into a finally digestible format for their clients. For client onboarding and data gathering, as we've explicitly mentioned, powerful account aggregation as part of a comprehensive financial planning solution eliminates a lot of the manual work advisors are doing, bringing on new clients, as well as updating during periodic reviews. And hopefully, again, that frees them up to do deeper and more financial planning. And finally, to segment clients, plans, and roles and responsibilities within the firm. Firms really need to be flexible and scalable within not just their planning process, but within their planning technology, so that they can serve different audiences, both internal and external, with different levels of employee and client access. A robust client portal really gives clients deeper insight into their plan's performance, and hopefully they are able to answer some of their own questions while also getting a better view of how their money is being managed. I think every enterprise firm is different. I know that some degree of customization is required based on internal requirements, but I think each of the three primary inefficiencies that we talked through today firms are all experiencing in some way or another and can be tackled with a robust planning solution.
Thanks so much for sharing your insight here, Connor. Enterprise advisory firms are finding entirely new levels of efficiency by deploying the right technology. So before we go today, I'd like to take one quick look at how advisory firms are seeing a return on their technology investment. I think this is so important to look at because when you're investing in the technology to build more efficient processes, you don't want the cost of that technology to outweigh your gains in efficiency. That's a really important part of this whole process. And even beyond that, you want your tech solution to provide ongoing benefits long after you've solved for your inefficiencies in terms of a better client experience and higher revenues. So taking a look at a recent survey we conducted of the eMoney advisor clients, there are a number of stats that jump out. First and foremost, 87% saw an increase in business efficiency, and 88% saw an increase in AUM, including 74% who said that they saw increased revenue from using eMoney financial planning technology. 69% said their clients are more satisfied because of eMoney, and 79% said that they've seen an improvement in client retention. 77% said they attract more new clients, and finally, 57% said they can more quickly develop financial plans. And we know that that is really, really key here. So the ROI story is clear. The right technology increases efficiency, improves the client experience, and directly leads to higher AUM and revenues, just like we were talking about at the very beginning of this session. The bottom line is that a lot of enterprise firms are experiencing the same types of inefficiencies. We talk to many different firms, and it's really similar. They're caused by the way these firms grow over time, how they manage internal data and client data, and how financial planning services and responsibilities are segmented and delegated. It's also part of a changing industry. There's changing regulations and rules that you guys have to comply with and come up with processes around and have oversight of your technology. So while there's not one uniform solution for every enterprise firm, there is a tech-driven way to adjust each one of these inefficiencies in a way that allows advisors to reinvest their time in revenue-generating activities that ensure the long-term profitability of the firm. So with that, that's all we have time for today. Thank you so much for joining us, and we hope you enjoyed our webinar. I know that we are a few minutes over time, so we will cover the Q&A and answer any questions afterward, and we will make sure that everyone gets a copy of this deck and hope to see you on the next webinar. Thanks so much and have a wonderful day.